What's up, guys? Mike Sharp here, Sharp Investing, and just up front, this is not investing advice. Now, a few of you posted that you wanted to see a full analysis of Liberty Global after I posted my purchase video. I have done that, but it's on punch card investing. So if you haven't seen, I'm doing a monthly segment there called Contrarian Corner. So I'll put the link here if I can. If not, it'll be in the show notes if I'm too stupid to figure that out. But one of the concepts, I want to talk about one of the concepts. So one of them that I brought up in the video was how the buyback, it can have an exponential quality to it. So I want to go through some of the buyback scenarios here to show you what may happen over the next 6 years as they buy back huge amounts of their stock. Now, this is the primary reason for buying the stock because they're buying at currently 15% of the float this year at a minimum, might move up towards 20%. So these are massive buybacks, and I want to show you what I mean by an exponential quality, which is code for non-linear. So the first example here is to show right now they're trending at about 390 million shares at the end of the year. So December 23, there'll be 390 million shares left. That is based on a 15% buyback, and my estimate is that they're going to spend between 1.2 and 1.3 billion this year on buybacks. Now, if they continue to spend that particular amount of money on buybacks, next year it's actually going, assuming the stock price doesn't move. So the idea here is if the stock price stays level, but you reduce the number of shares outstanding, the market cap comes down by the amount of the buyback. So at the end of the year, we might have a market cap around 7.2 billion. Next year, if they buy that 1.2 to 1.3 back, the market cap drops further to 5.9 billion, and they would have bought 17.6% of the shares back. So if they keep doing that and the stock price does not react, you'll see how every year a percentage of float goes up. And in 2028, they would actually be buying back 60% of the float, right? So that's what I mean by non-exponential. It kind of does this over time. And that, that's true of all buybacks, but it's not really noticeable when you're buying, 2, 3, 4% of the shares back because it's very slow. But when you're at 15, it can really start to ramp up. So I think that's what's happening here. Now, I don't think this is going to happen. I don't think that they're going to keep buying back shares and the stock price isn't going to move because at some point they're going to run into the strong hands, right? So you've got John Malone, you've got Seth Klarman who own 35% of the shares outstanding between them. And I would bet they are not going to sell the shares back into a buyback at $18. So at some point, all these hands that are the weak hands are selling back to the market at these low prices. At some point, those are going to be exhausted, and the stock price is going to have to adjust to where the stronger hands want to get paid. Otherwise, they just won't sell them. So here's another scenario. The second scenario I want to look at is, let's say the stock price just adjusts to the buyback rate. So what I mean by that is if they buy back 15% of the shares, the market cap will readjust to where it is now, right? So currently it's about 8.4 billion in market cap. And let's say they buy 15% of the shares back, which means the following year, the buyback would be 15% again, assuming the amount that they're going to invest in the buybacks is the same, 1.2 to 1.3 billion. So that puts the market at 8.4 billion, but there's fewer shares outstanding. So you can see if we look at the A shares currently trading at about 1750, they would have to move up to 2064 in order to adjust for the buyback. And then every year they move up a few dollars as the float reduces. And I think at the end of that process, assuming this all just stays the same, they keep buying back the same amount and the market cap adjusts, the price would be about 46.51. And that would give a CAGR of 19% per year. Pretty good return. So that's just one scenario I think may happen because I think that the stock price may just adjust itself to the size of the buyback. If they drop the buyback to 10% again, then we might see contraction in the other direction. But this is possibly another sort of long-term scenario that may play out. Now, it won't be linear. It'll do this, but over time, as the share count comes down, the share price should rise to accommodate that, assuming the cash flows are the same. And again, there is the risk that the cash flows could decrease over time. That's the main risk here. I actually don't think they will. I think they're going to go up because the CapEx, well, the management says CapEx is coming down, so that should increase the distributable cash flow. Now, those are just two examples to show how these buybacks can affect the stock price. But again, I'm not really betting on one particular one here. I'm just betting on that over time, huge buybacks mean the stock price should eventually respond to that. That's sort of my generalized thesis on it, pretty basic. But yeah, I think that's it for now. I just wanted to catch you guys up on what I was thinking there, because there was a few questions on it when I did the Liberty video. So hopefully that makes more sense. If you have any questions, please put them in the comments. Thanks for watching, and I will check you in the next video.